Michael Canavay, and I wanted to give you a brief capital markets update. It's the beginning of August 2019. A lot of things are going on in the markets right now, mainly political related. So if we look at today, the S&P 500 was down about 3%. Markets are down in the after hours. We'll see if that holds till the morning. A lot of it is about the Chinese currency devaluation, and that's kind of an esoteric, distant thing for a lot of people in their everyday lives. So I wanted to deconstruct why this matters and what's going on in the big picture for you. So I'm going to share my screen here, and we'll go through a few different slides that I've got for you. And we'll start with this one. This is China's main currency, and the yuan has depreciated rather significantly since 2018 in March. If you look back to March 1st, 2018, that's when President Trump announced his intention to impose a 25% tariff on steel and a 10% tariff on aluminum imports. In a tweet the next day, he, and that's what you see on the screen there, he made the statement, "Trade wars are good and easy to win." Well, I think he's finding out that's not always really the case. If we look at where that first tweet happened and where those tariffs happened, we can see that that's really when the Chinese currency peaked. They've used their currency weakening to mitigate a lot of the tariffs, because when they're weakening their currency, even if they're getting a tariff slapped on some of their imports, the currency devaluation helps erase some of that in terms of making their goods more expensive to export. And just today, actually, we got a tweet this morning after the Chinese policymakers announced that they were going to devalue the yuan and also stop buying certain U.S. agricultural imports. President Trump tweeted that the Chinese dropped the price of their currency, and he calls it currency manipulation, asked if the Fed was listening, and after hours, actually, the Trump administration's formally designated China as a currency manipulator. That's mostly a formality, but what it means is that the Treasury Department in the U.S. will work with the IMF to take a look at the situation and see if there's any type of fee or ramifications that they'd want to slap on China. But I think what this basically says is that trade has a lot of different variables. Tariffs are just one of them. Currencies also matter, and it's a complicated, thorny issue. If you look at back to late 2016 when President Trump was elected, I think the key thing to realize is that he's always had a desire to placate two different groups. In terms of his interests, I think he's always been interested in seeing the stock market go up. He definitely comments about the stock market much more than any modern president, and he seems to look at the Dow as one of the leading indicators for his reelection probability. The other thing that he's always tried to appeal to is a base that's largely, not as focused on the Dow Jones Industrial Average, because a lot of his base is in the Rust Belt of America, in certain places like the Midwest, where manufacturing jobs have been going out the door for a while now, and he's trying to appease to a base and the market at the same time, and there's just not a whole lot of overlap in terms of their interests. So that's, I think, what's happening right now is creating some trouble for political risks. Looking at why that overlap doesn't really exist between the market and Trump's base, I think you can take a look at where asset prices are right now in proportion to the U.S. economy. We're near an all-time high here, and what that tells you is that policymakers have been largely successful in stimulating asset markets, whether it's bonds, which I think have been helped by QE, where the Fed was buying bonds, or you could look at the tax cuts that Trump delivered last year is something that helped corporations and corporate profits. So that's simultaneously helped the equity market. And if you look at just where asset prices are in proportion to the broad economy, what that graph right there tells you is that this is the perfect symbolism of income inequality and where the populist angst is coming from heading into the 2020 elections. Wage gains have not been near all-time highs. So basically, it's a setup where, hey, capitalism works if you have capital in this type of an environment where asset prices are levitating higher as a proportion of the economy. Not everybody has capital. everybody's invested in asset prices and benefiting. So this is one of the reasons that I think you're seeing the Democrats and President Trump likely look at that, populist vote as something that's going to stay very interesting through the 2020 election. Where will each of those parties vie? I think the key thing is it's like oil and water between Wall Street and the political populist movement right now. An easy target that President Trump, I think, will go after, and you'll see this on the Democrat side too if you pay attention to the debates or some of the different policy ideas. The bang in the market is the Facebook, Apple, or Facebook, Amazon, Netflix, Google. Some of these big tech companies that are just taking in the lion's share of corporate profits in terms of growth over this cycle, they've got a big target on their back, I think. And that's because they have a lot of potential for antitrust regulation that could dent their profitability. That wouldn't just hurt those companies, that would potentially hurt Wall Street as a whole and the stock market, because these are key companies driving the cycle in terms of corporate profit performance and stock performance. So that's where, the oil and water analogy between Wall Street and Main Street, these things just don't mix right now. You can't go after the big tech companies. You can't go after China and all these different trade goals that the Trump administration seems to have and still have a healthy attitude on Wall Street in relation to the market. So it seems like he's at a point soon here where he's going to have to pick which side to focus more on. In terms of the trade war, I've never thought that, and if you read my blogs, you've seen me comment on this before, I've never thought that in isolation, the trade war was that big of a deal, because trade is not a huge part of American gross domestic product. I think it's about 8% of our economy's exports. So this stuff doesn't matter through that prism, but it does matter, it seems, more than maybe I would have thought a year and a half ago in terms of general psychology. So if you look on the left here, what you see is US fixed investment. That's a proxy for business spending. And since those Trump tariffs were announced in March of 2018, that was the peak in US fixed investment. So I've got it highlighted there with the orange circle. On the right side, you see the Global Economic Policy Uncertainty Index. That's really surged from the point when the tariffs were announced. And I think, the only reason it was a little bit higher at the end of last year there on the graph was because that was before the Federal Reserve in the US made their dovish monetary policy pivot. What we've seen this year is the global central banks all seem intent on stimulating asset prices and risk sentiment in the business community by keeping the lid on interest rates. That's reduced some uncertainty there, but you still have a lot of uncertainty tied to trade and things of that nature, and that doesn't seem to be going away. The way businesses are responding to the uncertainty overhang is they're buying back more stock and they're investing less in their business in terms of growth expansion. Goldman Sachs forecasts that stock buybacks will be close to $1 trillion this year, and that would be up 13% year over year. Meanwhile, capital expenditures in corporate America are only forecast to be up about 3% year over year. So that tells you where the cash flow is going. It's going back to, hey, do I want to invest long-term in an uncertain business environment, or do I want to just buy back my stock? And that's probably going to help the stock options of the person making that decision. So that's where corporate America has been leaning. And that's not necessarily healthy for the long-term growth outlook of the country. Another key part, of course, of GDP is the consumer. That's 2/3 of overall economic output in the US. And two charts here kind of paint a picture where I think that is a shaky foundation. The consumer has been very strong throughout this cycle. Consumers have largely carried this cycle. But what we see on the left there is consumer confidence recently came in near the high of late 1990s. And it's a good time to kind of ask, is this as good as it gets? Because consumer confidence, I just can't see a whole lot of rationale for why it would go much higher than the late 90s. That was a stronger economy, better wage growth, a lot of things that were working in consumers' favor. You know that if you were a consumer in that economy, and you can compare it to your impressions of now. So I think there's definitely some reason for considering maybe we're close to the climax here in consumer sentiment. On the right is a chart that shows you the relative relationship of consumer staples, things that are a fixed portion of people's budgets, in relation to consumer discretionary sector. And that's composed of retailers, things that make more luxury items that are more a discretionary purchase. That relationship looks to me like a double bottom in terms of that red line. It seems like we bottomed in spring of 2018, right near the same level as the spring of 2000. And lately, over the last year, the more defensive consumer staples have been outperforming the discretionary stocks. I think that's one of the classic bear market warning signs that I pay attention to. Meanwhile, the blue line shows you the Federal Reserve of New York, their probability of recession index has been spiking considerably. That doesn't guarantee that a recession is right around the corner. It just tells you that that red line might catch up with the blue line, and if it does, a higher probability of recession is indeed around the corner. And I think as a market participant or investor, if you're active at all, you have to look at this as a reason to kind of lean a little bit more conservative right now, and that's what we're doing. Valuations, I think when you take a step back and look at what is a PE ratio represent, to me it's a proxy for investor sentiment. How positive or negative are investors feeling about the future is really what's reflected in a PE, and specifically towards the earnings. If you look at the last 60, 70 years, the average price to earnings multiple for the S&P 500 is around 16.5. Right now, we're clocking in at about 18.5 on a trailing basis. You can see I've called it out there in the orange. Q1 of 2018 is when the peak PE was in place for the US. It was over 20 at the time. My personal read on overall sentiment is that was peak confidence in terms of the US economy and investors' minds. Because just like business fixed investments, since the trade war erupted in March of 2018, we've seen PEs come down, we've seen fixed investment come down. And I think that just shows you that this uncertainty overhang is taking a psychological toll that can't be ignored. In terms of S&P 500 earnings here, the good news in terms of the recent rearview mirror is that black line's steep ascent since 2016. That's corporate America growing the bottom line in a healthy manner. The red flag in this chart, however, is that you've seen that taper off and level off. Normally, when the black line intersects the dotted or dashed line there, which is a moving average, that's usually a classic indicator of recession around the corner. And we haven't dipped down yet, but I think that looks like the likely path it will traverse, especially if you look at where the earnings are likely to come in for the biggest sectors in the market, i.e. technology, financials. They've had really strong year-over-year earnings growth, but that creates more difficult comps going forward in the next few quarters where flat to down earnings for those key sectors in the S&P are quite likely, and that's certainly a market risk to pay attention to. Looking at valuations and comps overseas, I think you have a little bit less of a hurdle in terms of the expectations baked into valuations. That's what you see on the chart here. The 10-year moving average PE, which is just smooth earnings in terms of where the price multiples trade. MSCI ACWI is the all-country world index outside of the US. So this is all of your developed countries, your emerging markets. You could see where that light blue line is in proportion to the darker blue line, which is the S&P 500. There's a pretty big disparity. The US is trading a very steep premium to overseas. So that tells you there's probably likely to be a little bit more downside surprise power in the US. And if you look at another place like Germany, key export country overseas, they're probably already in recession. That's what you're seeing on the right chart there, where we've dove on the GDP readings in terms of the estimates for this quarter, next quarter. I think you're likely to see flat to slightly negative prints in German GDP, which technically qualifies as a recession. One of the reasons that I feel personally better about Germany and a number of other international countries over the next few quarters and over the next few years is they have easier comparisons. And that's what the bar charts in that chart is showing you, it's usually the case that when you have lower base comparisons, it's easier to exceed those weaker numbers on the next GDP print because everything's analyzed year-over-year basis. So very strong readings set up difficult comps, set the stage for weaker readings. That's definitely the case in the US right now. Overseas, we may see an economic trough here fairly soon, which if that's the case, especially given that those markets are cheaper, you could see a stock market bottom in the next couple quarters overseas and potentially a lot more upside than what you see here domestically. That's one of the reasons that we started international equity strategy this year, anticipating favorable tailwinds in some of those other countries compared to the US. So strategy summary. I don't want to overcomplicate things, and really to keep it simple, we're overweight the more defensive sectors. That would be things like consumer staples, utilities, real estate investment trusts, and healthcare. These are recession-resistant areas of the market where the earnings are more reliable. If we have fixed investment that stays depressed, if the consumer does falter over the next few quarters in the US, we're more concentrated in the areas that will be less sensitive to that. Other than that, the other thing that we're doing is we have above average cash balances, particularly if you've seen over the last few weeks, we've done a number of trades to increase the cash levels. And as we've been writing about, talking with clients about for a number of months now, we're overweight precious metals. That was a fabulous hedge today. The gold miners were up almost 4% when the market was down almost 3%. And that's exactly what we're looking for. So if we see continued uncertainty in the period ahead, I think that hedge will help, as will the cash. And at the end of the day, the way our stock selection process works, if you are familiar with it, you know that we always favor high quality companies at reasonable valuations. That helps quite a bit on days like today in the market. Even if we were fully invested, I still think we'd be set to weather the storm. But these are some of the extra safety measures we're taking. And I think in the next few months, we'll probably see a better backdrop for the markets. But until we get to that point, we're in hunker down mode, and we're of course available to answer any questions you may have about the overall environment or your portfolio. Thank you for your trust and confidence and attention.